Man, oh man, it has been a wild ride in the market the last few months. We've gone up, we've got down, we've gone sideways, we've gone every which way. And what I want to do is I want to kind of update you guys on how my portfolio is going, what changes I've been making, and I want to give you guys some reasoning behind the decisions that I'm making with my portfolio, what I'm changing, what I'm selling, what I'm buying, and what I see as the path forward for my portfolio. So let's jump right into it. First things first, you guys all know, I have a very, very concentrated position in Nvidia. Right now, my portfolio is 49.5% of Nvidia shares. That's the total net worth of the portfolio. The previous total was 49.8%. And so part of this reason is because Nvidia has fallen over the past few months from its all-time highs in the 150s. And at the time of recording this video, the shares are down to about $117, give or take. And so while I have bought more, my share position, the amount of shares that I have in the portfolio, has increased by 3.1%. So I have been buying Nvidia a little bit, but the total percentage of the portfolio being Nvidia has fallen by about 0.3%. So I've been buying, but not as much as some of the other positions. Now, CrowdStrike. This is my biggest buy of the last few months. I've essentially been pouring money into this as it's fallen from its all-time highs in the mid 400s. It's gone down all the way to $300. I saw this and my eyes just lit up. I had green dollar signs. Wow, what a discount. And so I was pouring money into this position. Right now, it makes up 20.4% of my total portfolio, up from a previous 15.4% of the portfolio. In terms of the amount of shares that I bought, I increased my total share count by 37.43%, which is a pretty good number, especially when the company dipped by around between 20 and 30%. VGT, the Vanguard Information Technology Index, currently makes up 14.8% of the portfolio, down from 16% previously. Now, there was a dip. It wasn't as big as Nvidia or CrowdStrike, but I also sold some of these shares. Now, the reason I sold these shares was because I saw a way greater opportunity in CrowdStrike. CrowdStrike dipped a ton, VGT dipped a little, so I figured I actually wanted a little bit more concentration in CrowdStrike, so I sold 4% of my shares and allocated those into my CrowdStrike position. Microsoft currently makes up 6.3% of the portfolio, which is down from the previous 7.5%. Now, Microsoft has been relatively flat in terms of its price over the past few months. Actually, really over the past year, Microsoft has been very flat. Now, I think Microsoft is a good buy. I made a video about this a few weeks ago. Microsoft, in my opinion, is an amazing company, and I think it's at a great valuation to buy in, especially if you don't have a position yet. Now, this 13% that I sold of my Microsoft position actually went into both my CrowdStrike position and into Nvidia. I was clearing up money for both. I was basically getting some cash from my Microsoft because I see a better opportunity in these other two companies. You know, Microsoft are going to grow expectedly maybe around 13 to 17% depending on the year. And I just see a much greater opportunity in both Nvidia and CrowdStrike, especially at the recent prices that we just saw them at. And so that is why I was selling out of my Microsoft position, despite the fact that it's such a great company. Now, next, Apple makes up 2.4% of the portfolio, which is down from 4.5% previously from January of 2025. That's about a 45.24% drop. And again, this was just freeing up more cash to feed these positions. MasterCard stayed relatively flat. The position increased by 0.26%. That's just because of a dividend. Same with Alphabet, AMD, Meta, and Visa. For the companies that do have a dividend, I just reinvested that dividend, and that's why the share count grew just a little bit, not too much. Now, what's important to note here is that these top two holdings, if you combine these, this is 69.9% of my portfolio. For most people, that's ludicrous. To be so concentrated into just two positions is a little bit crazy, and I acknowledge that. I acknowledge that there's a large risk that I'm taking, and there's a lot of volatility that I'm welcoming into my portfolio because of these weightings, right? But I'm okay with that. I research these companies through and through. I know what they do. I'm comfortable with the businesses. I love the business models. I think when you believe in a company, it's foolish to not concentrate yourself in those positions, especially if you're a young guy looking for high returns. And that's exactly what I am. I can recover from any of the mistakes that I make in my youth. And so me being 24 years old, I am perfectly fine taking a 50% loss on any of these positions because I will earn it back over the course of my lifetime. I'm not scared. And most importantly, I feel extremely comfortable in the research and the work that I put in to creating these positions in the first place. And I think that's a really important principle of investing. They say diversification is the antidote to stupidity. Well, time will tell whether I'm stupid, but I think that I've put enough work in and put enough research in, and I understand these businesses well enough to have concentrated positions within my portfolio that allow me to reap the rewards or the losses of whatever comes to me in the next 10 years. So the theme for this month in the market was the dip, right? We had a massive sell-off because, well, some people say it's because the market was overvalued. Some people say it was because the growth scare and the Trump tariffs and all of these other things. There were some indicators in the economy that people didn't like. But regardless of what the reason was for the dip, it's important that we take advantage of the lower valuations and buy the high-quality companies that are at a discount, or that you believe are at a discount relative to what you believe are the fair market value of those assets. And so, I've been saying this for a while, but I've been selling out of my Apple position because I don't really like the company and I don't think it really fits in with the other names within my portfolio. A lot of my other names are very high growth, very high potential for returns, but Apple, they're growing at a very, very slow, consistent pace, and I don't really like that. I would much prefer to have the money that I have in Apple and other companies. I've slowly but surely been trimming the position when the time is right, whenever I need the cash to put into other names. And so that's exactly what I was doing. Now, selling out of Microsoft and VGT, it's all the same reason, right? It's because I saw a greater opportunity in the other names. And according to my philosophy, you should only sell out of your positions for a couple of reasons, right? The first is because the company is bad. It's a bad company, right? If you bought into a company and you had this story and this thesis behind what's going to happen with the company, you made these assumptions, but now those assumptions aren't playing out in real time. The story that you've been telling has now changed. When you're no longer happy with the current story that's being told by the company, by the financials, by the metrics, whatever it might be, it's time to sell that company. It's really important as an investor, as someone who allows logic to reign within their portfolio rather than emotions. You have to accept sometimes we're wrong. We can't see the future. We can't predict what's going to happen with our companies. We can just make assumptions and guesses based on the evidence that we see in the present day. Now, if 5 years down the line, those assumptions are no longer met, maybe they're better. Great, keep the company. But in my case, I saw Apple as a growth company a few years ago, and now they're slowing down. And so the story for Apple has changed. They're more of a consumer staple than they are a growth company, and they're growing really slowly. And so I'm not really interested in keeping Apple within the portfolio. Now, the second reason is better opportunities elsewhere. In my terrible chicken scratch handwriting. Better ops. And now this is the reason why I sold out of some of my Microsoft and my VGT, right? VGT isn't a company, but it's a conglomeration of companies, right? And so I sold out of VGT because I wanted more concentration and less diversification. And for Microsoft isn't growing as quickly as CrowdStrike or Nvidia. I'd much rather sell some of my Microsoft, put it into CrowdStrike and Nvidia, get a higher rate of return over a long period of time than just keep it into Microsoft, which is a great company, and definitely an essential position in my portfolio, but a smaller return. And so that's where I'm at. So now let's go over some of the specifics on why I bought these, what are the metrics that I was looking at, and really go into the thought process behind what I'm doing. Now here's my disclaimer. The information provided in this video is for educational and entertainment purposes only. These are my opinions. This is not investment or financial advice. Please consult with a professional before making decisions on your own. I just want to tell you guys what I've been doing with my portfolio, but, don't sue me. Now, first things first, Nvidia. Nvidia hit an all-time high somewhere in the 150s, and they dropped down all the way below $110. And so I saw that, and I was just drooling. I was salivating at the opportunity to buy more Nvidia. And so the things that I look at for Nvidia to see if it's a good buy is, first of all, the forward PE, right? What is the company going to earn in profit over the next 12 months compared to what the price is currently? And so I think that a PE of anything less than 25 is really good. I think less than 25 is good. And so I saw that, and that's when I started to buy in. I think the gross and profit margins are phenomenal on this company. The gross margins are in the 70s, are in the low 70s, and they're expected to expand those margins in later next year. But I think if you invest into Nvidia, it's really important to consider that those gross and profit margins have the possibility of contracting. So if you think that's going to happen to a very large extent, then maybe this forward PE doesn't really mean anything, right? And so I'm assuming that the gross and profit margins are going to stay in that 70% range, somewhere between 65 and 80%. Next is the PEG ratio. Now, for the price to earnings growth ratio, anything less than a 1 is considered undervalued. And Nvidia was lower than a 1, and so that was just another indication for me to buy. The last key metric for Nvidia is the data center compound annual growth rate. So how much is their data center revenue segment actually growing quarter over quarter, year over year? And so we've seen outstanding growth in this segment, I think above 80% in the last year. And so it's really hard to not be happy with that. So when you put all of these different metrics together in Nvidia, that is painting the story that I need, that I would like in order to buy more and increase the position. Personally, I think anything under $120 for Nvidia is a steal. I am buying when Nvidia dips under 120. Now, this maybe category, for those who don't know, when I say maybe, I'm putting myself in somebody else's shoes, right? I'm saying if I didn't have a position in Nvidia, at what price would I buy in at? For me, if I'm going to hold this company for 10 plus years, anywhere between $120 and $140 is a decent price to get started at. Again, $120, that's a steal, but $120, $140, I would consider it, but I wouldn't be growing my existing position between this price range, right? Having 50% of my portfolio in Nvidia, that already brings me a lot of risk, and so I'm trying to reduce the amount of risk by not buying in at these higher valuations. The last is the hold. Anything greater than $140, I am holding. I will not be buying more Nvidia at these prices. I'll just be sitting around, and if a dip comes, a dip comes. The next company is CrowdStrike. Now, there are really just two main metrics that I look at for CrowdStrike. The first is the forward price to sales. Now, their current price to sales is around a 20, but their forward price to sales is around a 17. And personally, I think that anything below an 18 for the forward price to sales is pretty decent. This is a very fast-paced company. They're growing at a very high rate, and I think that they deserve the higher price to sales ratio. I think the average price to sales for cybersecurity is around a 14. And so being a little elevated on that price to sales isn't a killer, but anything above a 20, in my opinion, would just be a little too risky, especially since it's already 20% of my portfolio. Now, the second main metric I look at for CrowdStrike is the subscription annual recurring revenue growth rate. Now, what the ARR is it's basically telling us how successful CrowdStrike's subscription model is. When we think about another company like Netflix, they have a subscription, and you pay them every single month in order to get your entertainment, right? You can watch the Mike Tyson versus Jake Paul fight. You can watch some anime on there. You can watch whatever movie you want, right? People keep buying Netflix's subscriptions and paying them money every single month because they like the product. The benefit of the subscription business model is that it's very predictable. The amount of revenue that you're bringing in is very predictable, and investors like predictability. And so how fast this predictable revenue is growing is extremely important to me. And so the fact that they're growing it by greater than 20%, that's an indicator that this is a very healthy, fast-growing company, and I want to be a part of it. Now, my buy and hold prices, I think for CrowdStrike, anything under $350 for me is a buy. If it's between $350 to $370, it's a maybe. Maybe they have a really good earnings call. They're between $350 to $370, and I've got some extra cash lying around. I might buy in. But anything over $380, I would really be hesitant of buying in just because the valuation is getting a little bit closer to that fair market value, and I want a little bit of wiggle room between the price that I buy in at and the fair market value so that there's just some level of a margin of safety. The next company is Microsoft. This is a really mature company, so looking at the forward PE is a really good indicator for me of what the valuation is. I think Microsoft deserves a PE of 30. So if I see anything less than around a 28 on the forward PE, I feel very comfortable buying in. The second metric that I look at for Microsoft is their Azure growth rate. So how fast is their cloud computing services segment growing relative to the rest of the business? I think Azure is really taking advantage of this trend that companies don't want to go and buy and pay for their own data centers, right? They want to rent the rights to compute on somebody else's servers. And so Azure takes advantage of that, and they're growing extremely quickly. And that's why I'm invested in Microsoft. This is the main reason. So if this growth rate dips below 15%, I'm not going to be very happy anymore, and I'm probably going to start selling out of the company. My buy prices on Microsoft is anything less than $380, I think is a pretty decent buy. However, I'm not going to buy into the company if I see other better opportunities within my portfolio to add to. And so that's what happened recently, right? I saw better opportunities in Nvidia and CrowdStrike, so that's why I actually sold out of Microsoft to add to those positions. Just because Microsoft is right near my buy range, that doesn't necessarily mean I will buy. It's just a price that I would feel comfortable buying at. Anything between 380 and 420, I would say maybe, right? It depends. Maybe the Azure growth rate accelerates to 30 or 40%. In that case, I might consider buying more. But anything above $420, I would say, is more of a hold. That gives you about a 10% margin of safety for that fair market value of Microsoft right at $460. Now, the last company that I want to go over is Apple. Again, I look at the forward PE ratio for these really mature companies, and oh my goodness, Apple's is inflated, guys. They're growing at maybe 5% a year, and their forward PE is, I think, a 34-ish, right around there. The other thing I look at is the expected revenue growth rate. So if they're growing at 5%, guys, I have a saying on this channel, and it's if it's not over 15%, it's not worth my time. And so I don't want to bother with this company if it's growing at 5% a year. It's barely beating inflation. It's barely beating my bank account. Why would I be interested in Apple, especially when they're at such a high valuation? Anyway, that's why I've been selling out of it. That's also why I didn't include a maybe or a hold price. Honestly, I would buy Apple at anything less than $160. That's really low. And so the fact that the current price, the current valuation, and my buy price are so separated, that's why I sold 50% of my stake in Apple over these past few months. Now, I want to go a little more in depth on AMD. When we talk about AMD, I think investors severely misunderstand AMD. I think most people think of AMD as this consumer chip maker. They make GPUs, they make CPUs, and they sell them to put in laptops, they sell them to put in desktops and things like that. But people are really discounting the growth rate of their data center segment. The story on AMD has changed, and it has changed for the better. I've held AMD for a few years now, I think since 2021. And when I first bought in, I thought, oh, well, they're just going to sell more GPUs, they're going to sell more CPUs, more people are going to want to build their own computers, things like that. That's why I bought into AMD. But now, with AI, their story has gotten so much stronger. They're selling their AI accelerators to data centers, and they're making a ton of money. They've made a $5 a $4 or $5 billion business in the matter of a couple of years. And that segment is growing at an insane rate. AMD's share price right now is somewhere around $105. Their PEG ratio is at a 0.4. A 0.4. So when you look at the forward PE and the PEG ratio, the forward PE is around a 21, which is great in and of itself, right? AMD definitely deserves, in my opinion, a PE ratio of a 30. So that's 50% gains in that alone. The PEG ratio is a 0.4. I don't think I've seen a PEG ratio this low in my entire life. I don't understand it. People are sleeping on AMD. Nvidia's successes, all of what they've been able to do has been overshadowing AMD. And I think that this is one of those rare times where a very well-known company is extremely undervalued. And I can't believe that AMD is sitting at 105. It doesn't make any sense to me. And so I'm very excited about AMD. I'm definitely looking at adding more to my portfolio over the next 3 months. We'll see what happens. We'll see when I get money and how much I'm able to put in. But AMD excites me, especially at these valuations. Now, here's one thing, right? Here's one thing to consider. And I think this is why I've been a little bit hesitant on adding to my AMD position. AMD is the number 2 player. And just my own philosophy is I love winners. And so adding to the number 2 player, that adds a little bit of friction in my head, right? I have a little bit of friction there because I want the number 1 player. AMD's the number 2. So the question becomes, do I want to add my money into a company that's the number 2 player? Or would I rather just keep my money in the winner? So that's hard for me. And I'm going to keep doing research. I'm going to keep considering whether or not to add more to my AMD position. But the valuation alone looks phenomenal. It's just, I know they're the number 2 player, and that kind of hurts my head. It goes against my philosophy to add into the number 2 rather than the number 1. And so we'll see what ends up happening. I'm constantly trying to find new ways and learn as an investor. And this might be one of those situations where the valuation is just too tasty to pass up. So we'll see what happens. I'll keep you guys updated. For AMD, anything less than $120 is definitely a buy for me. Between $140, there's a maybe. And anything above $140 right now, I would say is a hold. But a hold is 40% higher than current prices. So again, there's a very big margin of safety in AMD. I think if I didn't have a position, my mouth would be absolutely watering right now. The last thing I want to go over is the historical performance of the portfolio so far. This portfolio started in January of 2019. So that's been about 6 years and 2 months since the inception, and it's done pretty dang well. The lifetime compound annual growth rate is 30.1% compared to the S&P 500's 14.5%. So we have doubled the S&P 500's returns on average over the last 6 years. That's really phenomenal. I'm extremely happy with the results, and I really hope to continue the success that I've had. But here's the thing. This success didn't happen overnight, right? This has taken 6 long years. And if you look at this graph, this portfolio did not happen without its fair share of headaches, right? I started with basically nothing. And over time, I've just slowly put in stuff from my work, stuff from my income. And I got up to here. This is December of 2021. But from December 2021 to October of 2022, I was down probably 50 or 60% that year. To say that I was a little bit scared is a bit of an understatement, but I knew that the research that I had done, the investments that I had made, all of the companies that I held in my portfolio were amazing companies. So I had confidence. I knew I can't sell, I can't panic here. I know that the only way from here is up, and sure enough, from October of 2022 all the way to December of 2024, my portfolio just kept on skyrocketing all the way up here. A lot of that is from the gains of Nvidia, a lot of that is the gains in CrowdStrike, and a lot of that is the pieces of the Magnificent Seven that I hold. Microsoft, Apple, Google, right? They had phenomenal years in 2023 and some in 2024 as well. And so now that everybody's panicking and everybody's selling because of all these tariffs, when we look at this little dip here from December of 2024 to now, this is nothing, man. I have held through way tougher swings, and I'm really, really excited about the next 6 years of my portfolio rather than just focusing on the last 3 months of what's been going on. Now, year to date, The performance hasn't been too great, but again, whatever, right? Short-term swings, we have a long-term, decade-long mindset. The S&P 500 has returned negative 4.33%, while my portfolio's returned negative 7.14%. So we're underperforming by about 3 percentage points. But again, that's fine. When you hold high growth stocks, when you're holding these high beta stocks, these are the swings that you just have to accept and be able to stomach. I've held through a bear market in 2022. I've held through way bigger swings, so this is really nothing to me. All of the companies in my portfolio are extremely high quality. They have extremely good management. They have extremely good products. And so these little swings that happen here and there, so what? I'm not looking out 5 months from now. I'm looking out 2 decades from now. And so I'm not worried about it. And I'm super excited to see where we end up at the end of 2025. Anyway, that's all I've got for you. I hope that updating you guys on my own portfolio and my reasoning for the buys and sells within it is really useful. I hope you guys can take something away from it. Please let me know what you think. Do you agree with my buys? Do you agree with my sells? Do you think I'm way too concentrated? Let me know down in the comments. Thank you all so much for watching, and if you think that I've earned it, please subscribe. Thank you again. Have a good one, and I'll see you next time.